Morning, everybody. Let's get the show on the road. So I'm going to be running through the week's news. I've only got a couple of things to look at. And then Matt's going to be talking to Keith Watson, who's the one of the managers of Guide Counter, which is the uranium fund. So news this week. I mean, we're not that busy, but a couple of things that leapt out to me. One is Bluefield, who've announced another acquisition. And the other is a statement from Ruffer, which just covers its the 6 months ended 31st December, and they're not particularly happy about the state of the world. Bluefield first. I think some sort of key takeaways on these. That all of these renewable energy funds have got a lot cheaper in terms of their premiums, and you can see that happening here. So the Bluefield NAV has actually been climbing again. After taking a little bit of a tumble during 2020, along with quite a few other funds. And those NAV pullbacks were really around the outlook for long-term power prices, which we'll discuss a bit more in a minute. But obviously, short-term power prices have been going up recently, and we'll see that too. And that's what's been lifting up the NAV of these. But inflation helps too, and so does a few other sort of bits and pieces, which we'll come on to. So first off, these things are definitely not expensive, but they are still trading at premiums, which is good. It just bought a portfolio from Good Energy Group of 6 solar plants and 2 wind plants, all in the UK. Good Energy is interesting because actually it's a client of GCP infrastructure. So the debt behind this portfolio has actually been provided by GCP infrastructure. So it's something that we kind of knew about already. And Bluefield's paying 24.5 million for their equity. Well, up to that, there's a price, and then there's a higher price depending on their meeting some due diligence milestones. As is sort of normalish for solar type portfolios, a lot of the income comes from subsidies, and these run through to about 2034, and then they'll start falling away. There's a bit more wind exposure in the fund now. So it's one of the things that they did last year is broaden their remit to include things like wind and some overseas stuff if they want. But it's really still relatively minor. So I still think we would see less than 10% of the portfolio being wind, and it's never going to come to dominate the fund. This is still essentially a solar fund, as they've committed to saying at least 75%. Here, is a little chart that shows that subsidy revenue and how that changes over time. Sorry, correction. Start again. Here's a little chart that shows the way that they've sold their power. So they have power purchase agreements for longish term sales of power, and they've locked in lower rates of power price. But those are gradually falling away over time. So as the old fixes, which are done in the sort of 40s pounds per megawatt, fall away, they're getting higher and higher prices on the new ones they're negotiating. They're also trying to negotiate longer term ones, so a couple of years rather than maybe a year and a half, say. And you can see that more and more of the fixed portion, the light blue portion at the bottom there, which is the revenue from the power price PPAs, is slowly becoming more variable. But the majority of the income is from the subsidies still, and that is fixed, as we said, until about 2034. Here's the charts of the power prices. This has really been going mental. We've been talking about it in a few notes recently. So this is lifted from the latest GCP note, which if you haven't read, you can have a look at. Baseload power prices have soared really because UK gas prices have been going up, because the marginal electricity that we produce, so effectively the electricity that sets the price for everything else, is gas plant. And as the price of gas has gone up, and also as the price of carbon emissions has gone up, which has another factor in this, that's been driving up UK power prices. They've been quite volatile, but they're still very elevated, and there's really no sign of them coming down yet. Part of that maybe is political tensions with Russia, because I think that they are deliberately squeezing the gas volumes that they export as a way of trying to get people to approve the Nord Stream 2 pipeline that goes to Germany. That's probably being counterproductive at the moment. I think the Germans are digging their heels in. But nevertheless, because there's greater global demand for gas than there used to be, so Middle Eastern plants and Asian plants are using much more of it. That's diverting gas that could otherwise have come to Europe, and that's sort of probably going to mean that the gas prices remain elevated for a long time, and so do power prices. What this knocks out the window is any idea that you want to build new gas-fired power stations in the UK. It's very unlikely that anything is going to try and do that for a while. Now, one of the sort of wonderful things about the renewable energy funds is that all of their subsidies are inflation linked, and not only are they inflation linked, they're linked to RPI and not CPI. So they're actually going to get some fairly chunky uplifts in the subsidy income because RPI is running much further ahead than CPI is. Slightly offsetting that, Bluefield's got some index-linked debt, but that is a relatively small part of the total, 61.6 million. This chart here, which is lifted from their website, just shows you how sensitive the portfolio valuation is to various assumptions within the calculation. So it's all done on a discounted cash flow basis. Inflation doesn't look very big on there, but that's looking at the impact of a 0.25% move. And obviously what we've seen inflation rates in the short term is that they've gone from sort of like 2%-ish up to sort of 7.5%. So that could be quite massive. But obviously what this is talking about is long-term inflation rates. So if inflation persisted at 7.5% forever, you would see an enormous uplift in the valuation of these funds. We're not talking about that, but we could be talking about longer inflation for a while, higher inflation for a while. And I think that probably means that that's going to carry on pushing up NAVs in the sector for a while yet. Discount rates may be affected by that. That depends on what happens to interest rates and market rates of interest. So that could be an offsetting factor, and we can't ignore that completely. But as you see, that's inflation for 0.25 and discount rate 0.5. So basically, they're not really comparable there. Power prices obviously have a massive impact. And again, we're talking about long-term numbers, not short-term numbers. So if the power prices persist for longer, higher power prices persist for longer, then that's going to be good news too. So again, the trend is to get higher NEVs. Energy yield doesn't change very much. That's just a question of how much the sun shines, and for the wind stuff, how much the wind blows. Asset lives, most of these things have got extensions already now. There's maybe a little bit of uplift in some of these funds, but that sort of game is over, I think, for a while. Operational costs are affected by inflation. So again, that's another offsetting factor. But I think what we're seeing is that the overall trend should be for the NEVs to be carrying on climbing, as they have been doing in the last couple of quarters. With this deal that's done, Bluefield now has about 400 million worth of debt, which means it is quite highly geared. We're knocking on towards the upper end of what it would ever want to do. So 41% loan to value, or 69% on a sort of conventional gearing message. There's about 15 million left of headroom in the revolving credit facility. I think there's doubt they use that. So I think what we're looking at is quite likely that they'll be thinking about raising more equity. They have said that there's quite a lot of stuff in the pipeline, and they've quantified that in the past. Obviously, that changes from day to day. So I would think it's not unlikely that, provided markets permitting, they'll be coming back and looking for more money soon. Now, Ruffer. So obviously very different funds in the flexible investment sector. Performance not been too bad over the last few years, as you can see there. That's helped move it on to a premium, that and greater fears of inflation, as we've been talking about. And that's helped expand too. So everything looks to be quite rosy for the Ruffer fund. Here it is in the context of some of the funds in the flexible investment sector. I've kind of knocked out some of the more weird and wonderful ones. So not all of these things are trying to achieve absolute returns, but they're all similar-ish. The big giant there is Rate Capital, which obviously is trying to protect your money over the long term, and trying not to have too big drawdowns when the market goes down. You've got personal assets and capital gearing, which are much closer to Ruffer. and then Mate Momentum, which are, and Aberdeen Diversified Income and Growth, which are trying to do something similar, but also pay you an income. So there they are. Ruffer is a reasonable size, as we say, it's been growing quite quickly, and it's also fairly highly rated. Nothing in the way of yield, because that's not it's what it's trying to achieve. Here are the performance numbers, and again, these funds are not really trying to knock the lights out. It's all a very sort of steady and cautious approach. So it's done a little bit better than personal assets and a little bit worse than capital gearing, and I think that's probably the only takeaway you need from that, because you can see the impact of the more volatile portfolios in here. So BMO Managed Portfolio Growth was one of the best performing funds in 2020. It's had a more tricky year in 2021 because of this higher equity and growth exposure, but whereas these sort of carry on powering ahead. Now, it's a complicated fund. There's a lot of stuff going in the portfolio. It's designed to produce this sort of downside protection and some sort of modest capital growth as well. So these are the impacts of the various asset classes over the last 6 months. And you see there's a lot of offsetting things here. So some things went up. So like equities went up by 1.8%, that's the contribution to NAV. But the puts that they've got in the portfolio, which protects against big sharp falls in the market, they cost 1.6. And that again gives you an idea of how expensive it is to protect these things through hedging. So credit protection costs 1.6%, for example. And that's slightly offset by the interest rate protection that they had and also index-linked bonds. So overall, it did go up, but most of the return here came from Bitcoin. And this is one of the reasons that I just don't like it. They had this sort of foray into Bitcoin that I just didn't really understand. It seemed just more like a gamble than an investment. It worked out extremely well for them, but that's kind of distorted the numbers. If we hadn't have had that, that would have been plus 0.8% for the 6 months rather than plus 2.8. Here's where the portfolio is at the end of December. And you see that equity exposure is still fairly low, and that's common to most of these funds. I think we think capital gearing probably has one of the lowest equity exposures of the lot. Index-linked gilts have been obviously working very well. Ruffer is very negative, really, about what's happening now, the state of the market, and they think it's very important that people do have some exposure to these kind of protection strategies. I think this is just something you're going to have to make your own minds up, because I think I'm not as bearish as they are, but you can see possibility of a pullback this year. They point to a number of reasons why they say that the market's particularly exuberant, and we've listed some of these here. So massive equity investment, number of IPOs, the whole SPAC thing, the whole crypto thing, the way that some little stocks in the States have been shooting up and down because people are sort of viewing them as sort of gambling rather than gamified trading, the Robin Hood type thing. You've got some very speculative companies being launched, and all of this is buoyed by very easy financial conditions. And that's let inflation run away. So we've got inflation at 40-year highs. And all of these funds have been saying that they expected the Fed not to be ahead of the curve. So the interest rates are not going up yet. They've said that they might do in 2022, but not very much has happened yet. And that's letting inflation kind of run away a bit. And one of the reasons for that is that, well, obviously markets are very finely balanced, and we could see quite a pullback if they act too aggressively. You think about things like house prices and what happened if mortgage rates shot up. You know, all sorts of leverage in the market that is relying on low rates. And they're saying that people aren't really factoring in very high inflation for a long time, but they think it could be high for a while. So that comes back to what we were saying about Bluefield and that inflation thing. I think the chances are that inflation will stay high for a while. It's good for governments in a way because it allows them to deflate away the debt pile that they've got. and that sort of resolves the huge spending thing that they've done, because realistically trying to recoup all of that through taxation would just be so depressive to the economy that it just wouldn't work, my view. So I think it's more likely that when they say the outcomes are either a sub-inflation boom, I think it's more likely that we'll get some kind of inflationary boom. But within that, there are a number of things going on, like the whole fight against climate change, which aren't going away. So I do think that when it comes to mining, which is what we're going to talk about next, that you do have a fair wind behind it. So that's enough from me, and I'm